You open your benefits portal, this open enrollment, and there's that one drop-down sitting there. Roth, traditional, or both. Financial YouTube has been arguing about that drop-down for 20 years, and I've watched the same argument play out every single year. Here's what nobody on either side will tell you. They're both right. About completely different futures, and you have no way to know which future is yours. If you're a worker contributing to a 401k in 2026 with $24,500 on the table this year, per the IRS limit, I want to give you the next 10 minutes of my life. Because I keep seeing the same mistake. People pick a side, lock it in, and never touch the dial again. That dial is the most powerful tool in your retirement plan, and almost nobody uses it. So here's the argument, stripped down. The Roth camp wins if your tax rate in retirement turns out to be higher than it is right now. The traditional camp wins if it turns out to be lower. That's the whole math. Both sides are right about different futures. The question isn't who's right. The question is, which future are you in? And the honest answer? Nobody knows. Which is exactly why, for 2026 contributions, neither pure Roth nor pure traditional is the right answer. Splitting them is. And the rules just changed in a way that rewards splitting more than they used to. Stick with me, because the part most people miss isn't the split itself. It's the reason the split got better in 2024, and the reason your retirement tax bill is probably worse than your spreadsheet thinks. Let me prove the unpredictability point first, because if you don't buy this, nothing else lands. The Tax Cuts and Jobs Act in 2017 rewrote the brackets. The top rate dropped from 39.6% to 37%. The middle brackets, 25, 28, 33, became 22, 24, 32. That whole package was written with a sunset date, December 31st, 2025. For an entire decade, financial advisors built urgency campaigns around that sunset. Convert your IRA now. Pay taxes at 37 before they go back to 39.6. Then July 4th, 2025 happened. Congress passed the One Big Beautiful Bill Act. Most of those individual provisions made permanent. The sunset that drove a decade of Roth conversion urgency just vanished. Every advisor who based their advice on that deadline got hosed. And I include some past versions of myself in there, to be fair. That's the cleanest proof I can give you that tax policy is genuinely unpredictable on a multi-decade horizon. But zoom out further. The top federal tax rate in 1980 was 70%. In the early 1950s, it was over 91%. Tax rates aren't a one-way ratchet, they go both directions. Anyone who tells you they know which way they're heading by 2056 is either selling you something or selling themselves something. Neither is helpful to you. If you've been frustrated by contradictory advice, that flutter of, wait, who am I supposed to listen to? That little like button helps me know which of these to make more of. Here's where it gets interesting, and here's the rule change most older content hasn't caught up to yet. December 2022, Secure 2.0 Act. Tucked deep in the bill is a provision that took effect in 2024 and barely got covered. Required minimum distributions on Roth 401k accounts? Eliminated. Gone. Why does that matter? Because before 2024, your Roth 401k had RMDs at age 73 or 75 depending on your birth year. Same as a traditional 401k, the government would force you to start pulling money out. Now, your Roth 401k can compound untouched for as long as you live, and whatever's left, your heirs eventually receive. Think about what that does to the math. Picture this. You're 45. You're on track to retire with, say, $1 million in your 401k. Under the old rules, half of it being Roth meant the Roth half still got forced distributed at 73. Now that same Roth half can sit there for another 20 years past your retirement date, compounding tax-free while you draw from the traditional side first. The Roth side of a split is materially more valuable than it was before 2024. Most financial advice on this topic was written before that change. Just check the upload date next time. You might be thinking, okay, but is it really enough to swing the decision? That's a fair pushback. The Roth versus rate prediction game is genuinely close. What this rule change does is tilt the value of the Roth side independent of the rate prediction, which is the whole point. You don't have to be right about future rates to capture the new compounding window. The math is cleaner than it was. Now here's the bigger reveal, the hidden benefit nobody models, withdrawal flexibility. When you retire with two buckets, a Roth side and a traditional side, you get to choose which bucket to draw from each year based on what's actually happening in your tax life that year. High income year, pull from Roth, tax-free. Low income year, pull from traditional, pay tax at a low rate. You're managing your taxable income in real time. This is not theoretical. Picture this. You're 70. You and your spouse are pulling $48,000 from your 401k to live on. Traditional 401k withdrawals get taxed at ordinary income rates, not capital gains. So your statement balance lies to you. At a 22 to 24% effective rate, every dollar in your traditional bucket is worth about 76 to 78 cents of spendable money. Your $1 million account, closer to $760,000 of actual spend. That's not a rounding error. That's $140,000 of phantom balance. But the Roth side? Every dollar is yours. So when a year hits where you have a big planned expense, a roof, a medical bill, a wedding, you pull from Roth and your taxable income doesn't move. Your bracket doesn't move. And here's where it compounds. Two more things happen in retirement that the binary advice ignores. First, Medicare premium surcharges, which the IRS calls IRMAA, kick in at $106,000 for single filers and $212,000 for married filing jointly. Cross that line by $1, you pay a surcharge for the entire next year. A big traditional 401k withdrawal can push you over. A Roth withdrawal doesn't count toward the threshold. You stay below the line. Second, Social Security. It becomes partially taxable above certain income thresholds. Same problem. Big traditional withdrawals make more of your Social Security taxable. Roth withdrawals, however, do not. So having a Roth bucket isn't just a bet on future tax rates. It's a control valve for two of the three biggest tax landmines in retirement. That's the part the all Roth and all traditional camps both miss. Optionality has dollar value, and you don't get optionality from picking a side. If you've made it this far and you're thinking, okay, this is the kind of distinction nobody made on the first explainer video I watched, that's literally the channel. Subscribing is how you get the next one in your feed. Now, how do you actually do this? In most major plans, Fidelity, Vanguard, Empower, Principal, you log into your benefits portal, and your contribution shows up as a percentage of pay. You can split that percentage between a Roth subaccount and a traditional subaccount. Set it to half and half. That's it. Save. Done. A couple things to know while you're in there. Secure 2.0 now lets your employer offer Roth matching contributions. The old rule was that the match went into traditional regardless of what you elected. That's no longer automatic, so check your plan documents. If your employer adopted the Roth match option, you can take it as Roth. If they haven't, your match still goes traditional, which actually pairs nicely with a Roth-heavy employee contribution. There's also no income limit on 401k contributions. Roth 401k specifically has no income limit either, which matters if you're a high earner. Roth IRA starts phasing out at $153,000 to $168,000 of single income. But the Roth side of your 401k stays open at any income level. By the way, there are basically three flavors of person watching this. Somebody just starting their career, somebody mid-career trying to undo a one-bucket mistake, or somebody 5 years from retirement trying to optimize the last stretch. Drop in the comments which one you are. I use the most common answer to pick the angle on the next video. If you're a single filer making $120,000 right now, you're in the 24% bracket. The 22% bracket for single filers tops out at $105,700. The 22% bracket for married filing jointly tops out at $211,400. Knowing where you sit in those brackets is the only homework. Once a year when you do your taxes, look at your marginal bracket. If you've moved up or down significantly, adjust the split. You're not locked in. The whole point is the dial. Quick caveat, and this is where the 50-50 default doesn't fit. There are situations where a more concentrated approach is genuinely better. If you're early in your career, low income, low bracket, you should lean Roth heavy. You're paying tax at the lowest rate you may ever see. Conversely, if you're a high earner with a high probability of dramatically lower income in retirement, say a surgeon planning to fully retire at 60 with no consulting income, leaning traditional now makes sense because you're deferring at 32 or 35% and pulling at 12. Some advisors will push back on a default split for exactly this reason. They're not wrong about the edge cases. They're wrong about how many people sit in the edge cases. For most people watching, you're in the messy middle, $80,000 to $200,000 household income. Bracket today is meaningful, retirement bracket is genuinely uncertain, and the cost of being catastrophically wrong on one direction is asymmetric. You'd rather be partially right than confidently wrong. The split keeps you safe. So here's the action plan, 3 steps. Today, log into your portal and set your contribution to a 50-50 Roth traditional split. Next, mark your calendar for the day after you file your taxes. That's when you check whether your bracket moved and adjust the split if it did. And finally, check whether your plan offers a Roth match option, because that's an extra lever most people don't even know they have. This is general education, not personalized advice. Before you commit to a split or change your election, talk to a financial advisor or CPA who can model your specific bracket trajectory and your state tax situation. Both matter and neither one fits in a video. 20 years of arguing about this, and the answer was hiding in the dropdown the whole time. You don't pick, you split, you revisit. The rules now reward that more than they ever have. If you want to take the next step, actually building a sequence of tax-advantaged accounts that gets you to financial independence on your terms, not your employer's, I made a video about exactly that. It walks through the order, the trade-offs, and what happens when you do everything you're told to do for 30 years and the math still doesn't quite work. It's on the screen now. I will see you there.